Asia and Market Group. Joining us today are Chakri Lokapriya, CIO and MD at Tcg Advisory. Chakri, good to have you with us. So what's changed since we last spoke? Things seem to be a bit more cheerful.
Indeed. I think what we're seeing is a couple of things. Is one, India's earnings for the concluded quarter was slightly better than expected. And this trend is actually mirroring across the region. Even other emerging markets have reported better than expected earnings after 2 lousy years in the past. So there is a greater amount of confidence. FIIs, while inflows have been positive, are nowhere close to where they were many years ago. So I think the sentiment is better as the data is getting marginally better. Okay.
And when we're talking about data, I mean, are you also looking at the growth figures that we've had? You know, the inflation and IP numbers of late haven't been awe-inspiring.
You're absolutely right. Manufacturing continues to be weak and will probably continue to remain so for the next maybe year or so, because private capex is unlikely to come back. On the other hand, services has come back, and services has largely been led by government-related services, defense spending, which have improved. And I think so. India is largely a services economy. More than 2/3 is a services economy, which bodes well because at least it starts creating jobs at the low end of the pyramid. And as we progress, hopefully the job creation moves up the pyramid.
Morning, Chakri. For a moment, I wanted to leave the correlation of the economy with the markets, because we have many types of investors. And maybe value investors start feeling uncomfortable when a market goes away from whatever their anchor is. And we've seen in global markets when that happens, and I just wanted to take you back to what happened before with the Asian tigers, and even before that with Philippines and Taiwan, where some of these markets actually rose 10 to 20 times. Essentially what I was driving at is, do you think we are in an asset class market, which is very different than saying we have a bull rally?
Right.
What are your thoughts about that?
We are not yet in a bull run, I think, and fortunately so. We are in the beginning stages of a recovery. If you look at from, let's say, Lehman to now, earnings growth has been hardly about 5%. If you leave out the Lehman crisis, that is 2008, so if you start from 2009 to present, the market returns, Indian market returns, have been about 14–15%, for an earnings growth about 9–10%. So one can argue that the market is not overheated because it has delivered slightly above the earnings growth rate. And then on the other hand, has earnings growth rate been a strong number? No, because an 8–9% earnings growth rate from 2009 to 2016 is a very anemic number. If you compare it especially to pre-Lehman crisis, when earnings were growing at more than 20%, 2003, 4, 5, 6, and 7. So one can argue that at this point in time, earnings will recover as we go out into the outer years in 1 or 2 years, and therefore market returns can go higher. So we can expect higher market returns.
Okay, so let's talk about a year-end outlook then. And I'm also seeing it from the point of view that globally as well, we're seeing this uptick. Everyone's been waiting for this great crash that hasn't come, even in the US. So we're entering, a part of the year where there's going to be a lot more action going forward. So yes, some volatility expected, but overall, what's the kind of, target that you have?
I'm actually beginning to feel more positive than the previous months for 2 or 3 reasons. If you look at the US, unemployment is at its lowest level. Personal consumption in the US is improving. Personal debt levels in the US is at low levels. Corporate balance sheets are fairly strong. And so against this backdrop, US is doing fine. If you rewind back towards the beginning of this year, China was trying to reposition itself from old China to new China, old China being manufacturing, new China being consumption-led. If you look at the latest quarter in China, most of the earnings came from these new sectors, which is healthcare, e-commerce, IT as in software. And whereas its manufacturing continues to decline. So China is just not falling off a cliff just yet. It is managing to transition itself. And as far as India is concerned, finally, while manufacturing is still bad, services is picking up. And if these actions, such as trying to clear up these construction projects, etc., by the government, the stalled projects, you could see another leg up, because that creates jobs as the stalled projects hire people to start working on.
Chakri, if we may just focus on a couple of things which the market has noticed and some the market hasn't. So one, automobiles. And we've discussed this a couple of times, that looks like we are at the next inflection point, because the price points for buying automobiles and three-wheelers have fallen so much. And the minimum salary, if it goes to 18,000, we are in the mid category of countries. How significant could be the ramp up? And also, could pricing power go back to these companies, because Maruti is already at a state where they're on a 6 to 8 week waiting list?
Indeed, very interesting questions. If you look at the data, recent data, and trends more importantly, vehicle sales have been strongest in that either two-wheelers have been strong, or if you take cars, they're in that 5 lakh to 8 lakh kind of a range. So it is your common person items. They're not the luxury items, so-called luxury items, but the beginning end is doing well. And also that trend correlates well with, if you look at all these various NBFCs who lend, they're lending to that segment of the population is actually being very strong. And then you look at a car manufacturer itself, or a two-wheeler manufacturer itself, because of the fall in commodity prices, etc., their prices have come down. Advances in technology has allowed them to move. If you look at today, your car dashboard, your interiors, your bumpers, etc., have all moved away from metal to various forms of plastic, polymers, etc., reducing the cost of manufacturing a car. They've passed it on, some of it, to the consumer. Car prices coming down, two-wheeler prices coming down, demand going up. So I think we will see, continue to see an inflection point as this income for the lower end of the pyramid goes up. There is this huge aspiration to buy a two-wheeler, to buy a car, and that will begin to manifest itself.
Okay, let's talk about banking and financials, because they have been on a roll, and everyone's very gung-ho about the story and the sector and how it's going to grow and the amount of new fresh paper that's going to come in as well and so forth. How do you see trends there shaping up? What would you invest in? It's such a huge pocket of the market.
The last time we spoke, and I had advocated PSU banks. Fortunately, they have done well, and I'm still sticking to PSU banks for the simple reason that any corporate demand corporate demand loans is met by PSU banks and not private banks in general, because most of these guys, whether it's an HDFC, all these guys are focused on retail lending. And so whenever corporate lending comes back, which it has to at some point in the next year or two, you will see PSU banks beginning to benefit out of it. And second, even after this run-up, their valuations are still attractive, because they're still in losses, they still have high NPAs, will continue to report high NPAs for the next quarter or two. And if a couple of these government initiatives, such as releasing the money which is pending in litigation, it actually reduces bank NPAs, it improves working capital cycles for companies, and which changes the whole story that, so far the whole story has been the corporate is the bad guy. It's actually not. It's actually these NGT, NHAI, who have created these litigations, which has put the money, which has stalled these projects. So I think bank valuations are still very attractive and will continue to do well.
Chakri, one of the challenges is that it's not necessarily everybody has incremental capital coming in, but they need to get out of something to get into something. Mm-hmm. And in such fast-running markets, it's a challenge because you're just selecting between a fast and a slower horse. Right. Does one get out of IT and pharmaceuticals?
I think so. And from our last interaction to now, things have actually gotten worse for IT and pharma for two slightly different reasons. IT is Brexit. While initially it was thought it was only the UK, but EU also will contribute to the slowdown. One is that one can argue that it is a short-term phenomena. On the other hand is innovation. Recently you had the CEO of one of the largest IT companies saying that innovation was not happening at even IT services companies, in Indian IT services companies, at the pace that it ought to be happening. But innovation doesn't happen in an organization where you have 200,000 employees by a flick of a switch. Innovation comes from hiring the company's business model, of the kind of products that it makes, and therefore the kind of high-skilled employees that it earns, the focus on R&D, etc. So while all these things are good things, will probably happen over time. Meanwhile, I think IT will derate for some time. Pharmaceutical, again, until they fix their FDA and product issues, which is again not a quick fix thing, where earnings will slow down.
Just follow up on this, an issue that hasn't been dealt with any of the analysts. But if I read correctly, Infosys must have close to 2 lakh workers. So would Wipro, something close to it, and so would TCS. My numbers may be incorrect on the exact number. But to me, they are starting to look like the Indian Railways. And I'll tell you why, not in their business. But nobody here talks about pension liabilities. If you're going to have millions of employees who you're going to pay pensions forever, to me, they look like the biggest liability sitting around, forget their business.
That's an interesting point, but I think fortunately for them is the average employee sticks around for maybe a few years. Unlike in railways where they stick around forever. From they join the company and they retire in the company. These guys join maybe 4, 5 years, 6 years later they're gone. So the pension liability doesn't stick around after a point given because of the employee attrition. I think that is a big saving factor, if you will, and will continue to remain so because their attrition levels are still very high.
Okay, we've actually been also taking a look at how how the larger market has also been participating in this rally, and there's really been a broad-based spree here. Are there any? Do you feel that some of those themes have topped out? Would you still be looking at some fresh themes?
It's good. It's a good thing that if you look at take Nifty as an example, or IT and pharma as examples. Now, IT and pharma together are probably a good 20% of the Nifty, and their earnings are slowing down. Last year, you had banking, all the PSU banks, earnings were negative and therefore not contributing to Nifty growth. So Nifty at each point in time, or even a broader index at various points in time, the mix keeps changing. So by going by your analogy of you have to keep shifting your horses, and so from that perspective, the market is not overheated or individual companies are slowing down, so you change your own mix and then you move forward.
Chakri, one of the things you see when you study in the US is that they teach you whatever ideology they like. So nobody teaches you socialism or communism. When it comes to that chapter, the professor quickly shifts back to democracy. Now, in finance, I noticed that nobody teaches you technical analysis, or that there are absolute return traders, that there are traders who basically close their eyes and just trade exchange-traded funds. You're only taught Graham, Dodd, value, Buffet. So these guys basically don't allow you to think, because your entire mind space is stuck with this Warren Buffet and his coterie of whoever discovered value. Though Mr. Benjamin Graham himself said, I don't think it's worth wasting your time in research because it's not worth it. I mean, this is his words, not mine, at the end of writing everything he said. Can't we just get away from this valuation perspective and just say, hey, the market's running. That's because people can flip stocks at a higher rate at which they purchase. Maybe that's where we are.
I agree with you in the sense that at least one part of it is valuation makes sense at various points in a cycle. And at this point in a cycle when earnings are not there, valuations are therefore looking expensive, valuation is not the end all for focus in picking your stocks. And if you're looking at future growth, etc. And that part of it is that reflexivity story which George Soros talks about is you believe the markets are expensive and therefore you look at the markets in that way, and that behavior becomes a self-fulfilling prophecy, and which creates a lot of opportunities for others who can find those opportunities, as you rightly mentioned. And that's what we focus on, because we don't think valuation is the end all of everything. It is important, but we need to focus on other factors, including sentiment and technical analysis.
Okay, so we've talked about banks and auto, somewhat consumption. What are some of your favorite areas of the market right now?
I think it will continue to remain banks. Within consumption, it's broadening, because right now you have personal consumption at its early stages of its growth. Within industrials, now construction, if these pending litigations are cleared by the government and they release that 700 billion rupees of stuck money, which eases life for all these construction companies, private capex is not going to come back. So I think we will still look across sectors for companies with low capacity utilizations. Because when you go from one shift to two shift, for the second shift you'll hire a new bunch of people to work for you. I think that's where the job creation will happen, but not these big bang new factories being setting up. That big bang thing, I think the government also has to do it, and building new roads, etc., and all that stuff. But I think the most important thing to focus on, so those are the things we're focused on, but watchful that fiscal deficit is still can miss the target, which is not a good thing.
Chakri, on infrastructure companies, I'm personally not convinced that the government releasing funds is the end of the story. What I find here is people trying to run Harley Davidsons on 50cc engines. You don't have the money. You continue to take on projects that you can't fully execute, and you're executing them on borrowed money, which is basically taxpayer money. So in effect, you're making the nice cream spread. The taxpayer pays for it anyway, even though it's not public sector. And I'll take a personal example. If I had a mortgage and the government gave me a tax deduction, and I go ahead and take 2 more mortgages, that doesn't make me a better person. That is stupid, because I should have first finished paying the first mortgage. That's not happening with these companies, Chakri. So what I find here is maybe they're making money, maybe they're making the spread, and they're not sharing anything with any investor. I haven't seen any payout, maybe leaving an L&T or maybe 1 or 2 others, where you as an individual have really participated in India's growth because of these infrastructure companies.
It's a classic gold rush kind of a story, where the person selling shovels to the gold diggers made more money than those guys actually digging for gold. And these infrastructure companies, unfortunately, they just focused on growth during the high growth years, and kept reinvesting back into the company and borrowing, and their leverage went up. And that's what caused all this slowdown in these last 4 or 5 years. Today, it's not that they're better human beings or more smarter human beings, but unfortunately, or rather fortunately, they're constrained that they cannot take up more leverage, and they need to de-lever down in order to revive their businesses. And so when in that process, you can make an extra investment return. It's not that a huge amount of behavioral change has happened, I doubt it, but just that this forced discipline will allow some amount of investment returns.
All right, fair enough. What about some of the impact of fund flows going forward, given that we are watching out for elections in the US, we may still see that rate hike, may not, and perhaps we're not completely in the clear with regards to risks on a global front?
You're right in the sense, and also the next year we also have the Mauritius Treaty and the new Mauritius-Singapore Treaty kicking in, capital gains. Now, capital gains, introduction of capital gains can be a negative thing, simply because domestic investors are not exposed to foreign currency risk, whereas foreign investors are exposed to foreign currency risk. Your rupee depreciates, and therefore your returns go down. And while there has been a representation with the government to try to fix this oversight by the government, I think if it does, it'll help FII flows to accelerate. Otherwise, next year we can see a blip depending on how the economy is actually doing. If the economy has picked up sufficiently, FIS flows might continue, otherwise vice versa.
Chakri, I absolutely loved your thought about that. In a gold rush, why don't you buy the shovel guy rather than the gold digger himself? So I'm trying to figure out while you were talking, where is the gold rush now? Certainly it's in automobiles.
Right.
Certainly it's in NBFCs. And I'm trying to figure out who's giving them the shovels. Maybe the guys supplying them software or whatever. And third, maybe even in refineries, downstream, upstream. How do I buy the shovel guy?
Yeah.
And who are those guys for some of these sectors?
Good question. I need to think through this. I'll do some work on it. But all the auto, you mentioned autos, the auto ancillary guys. You buy the auto ancillary companies. And you buy, so various sectors. Now, in case of these infra companies, you buy the banks. They provide the finance. Their finances improve as a result. Consumer companies, because of the fall in oil prices and various commodity prices, the input costs have come down for various things. Packaging, packaging companies, infra companies such as the Jain Irrigations, Finilex of the world, those companies. All these companies will benefit. So there is sufficient room out there. There's a huge sector. Tire companies, their input costs have come down. And they will all benefit from this process of revival of the economy.